Linda is standing in her kitchen in Ohio at 7:12 in the morning, one hand on a coffee mug, the other hand opening her bank app before work. She is 46 years old, an office manager, and she has done what every responsible article told her to do. She has an emergency fund, not in checking, not mixed with grocery money, not invested in the stock market. $20,000 in a separate savings account with a name she typed herself, emergency fund. The balance has not gone down. The bank is insured by the FDIC. The logo is familiar. There is no chart moving red and green every day. No panic, no temptation, no drama. To Linda, this is what adulthood looks like. The money is there if the furnace dies, if her car needs a transmission, if her hours get cut, if life decides to send an invoice with no warning. Then she taps the interest line. Last month, her $20,000 earned about $7.50. She stares at it for a second. Not because she expected to get rich. She knows this is not an investment account, but $7.50 feels almost insulting. Across the country, Marcus is sitting at his kitchen table in Texas after dinner, scrolling through a different bank app with a very different feeling. Marcus is 39, an HVAC supervisor, and he recently moved his own $20,000 emergency fund out of a large national bank and into an online high-yield savings account paying 4.5% annual percentage yield. He did not buy crypto. He did not put his rent money into a stock fund. He did not chase some complicated strategy on the internet. His money is still cash, still liquid, still, in his mind, safe. But instead of earning Linda's roughly $90 a year before taxes, Marcus is on pace to earn about $900 before taxes. Same $20,000, same emergency fund idea, 10 times the interest. Marcus looks like the winner, and to be fair, he did something genuinely smart. Linda is protecting liquidity and principal. That is rational. Marcus is correcting an obvious mistake. That is rational too. Neither one is reckless. Neither one is gambling. Both are following the basic personal finance rule that gets repeated everywhere. Keep emergency cash safe, separate, and accessible. Linda chose the strongest feeling of safety. Marcus chose the stronger rate. But this is where the trap gets quiet. Linda thinks safety means the bank deserves to pay almost nothing. Marcus thinks a higher bank rate means the problem is solved. And both of them are missing the same thing. The bank is not simply storing their money in a digital vault with Linda's name or Marcus's name on it. A bank deposit is part of a larger profit machine. The bank pays one rate to attract deposits, then uses its balance sheet to earn another rate through loans, securities, reserves, and short-term instruments. The customer sees a savings account. The bank sees funding. The customer asks, "Is my money safe?" The bank asks, "What does this money cost us, and what can we earn with it?" That gap is the spread, and the spread is where the story really begins. Linda's $20,000 at 0.45% earns about $90 a year before tax. That is the visible number. Marcus's $20,000 at 4.5% earns about $900 a year before tax. That is also visible. So Marcus is clearly doing better than Linda. But better than Linda is not the same as best available. If similar short-term Treasury exposure is available near that same 4.5% yield, then Marcus may still be paying for convenience without realizing it. And in states with income tax, such as California or New York, Treasury interest generally has an advantage because it is taxable federally but exempt from state and local income tax. That does not make Marcus's high-yield account bad. It is not bad. It is miles better than being paid almost nothing. The trap is believing the bank is the final destination for safe cash, instead of seeing the bank as a middleman between your cash and the cash market underneath it. This is why the psychology matters. Safety feels like a logo. Liquidity feels like permission to stop thinking. A higher savings rate feels like victory because it is compared to a terrible rate, not to the yield your cash may be able to access more directly. Linda is being underpaid, obviously. Marcus may be underpaid quietly, and the danger is not that Linda or Marcus will lose the $20,000 tomorrow. That is not the main issue. The danger is letting the bank keep part of the yield your cash could earn directly from treasuries or treasury-backed cash funds. Linda saw $90 and felt disappointed. Marcus saw $900 and felt smart. But the real question is not which account looks better on the app. The real question is who is capturing the spread on safe cash. Professor Wealth ran the numbers. Linda saw $90 and felt disappointed. Marcus saw $900 and felt smart. But the real question is not which account looks better on the app. The real question is who is capturing the spread on safe cash. Professor Wealth ran the numbers. Start with Linda, because Linda's numbers are the cleanest version of the trap. She has $20,000 in a big bank savings account paying 0.45% annual percentage yield. That sounds small because it is small. $20,000 multiplied by 0.0045 gives her about $90 of interest in 1 year before taxes, not per month, per year. If Linda is in the 22% federal tax bracket and pays about 5% in state income tax, she keeps roughly $66 after taxes. That means her emergency fund earns about $5.50 a month, and Linda does not feel like she made an investment decision. She feels like she avoided one. The account is FDIC insured. It is separate from checking. It is easy to access. It has the name of a bank she recognizes. Safety feels like a brand name. And because the balance does not go down on the screen, she assumes nothing is being lost. But if inflation is running at a simple assumed 3% a year, Linda needs $600 of annual purchasing power just to keep her $20,000 even. She receives about $66 after tax, so her real loss is roughly $534 in 1 year. The number on the app still says 20,000 and change, but the buying power is leaking. Over 3 years, if her rate stays around 0.45%, her account might earn about $270 before tax. But at 3% inflation, the purchasing power of $20,000 would need to grow to about $21,855 just to stand still. That quiet gap is around $1,585 before even considering taxes. She did not lose principal, she lost what the principal could still buy. Now, compare the same $20,000 three ways. At 0.45%, traditional savings earns about $90 before tax. At 4.5%, high-yield savings earns about $900 before tax. At a similar 4.5% in short Treasury exposure, the gross interest is also about $900 before tax, but with potential state and local tax advantages. Same emergency fund. Same desire for safety. Very different leakage. This is where Marcus enters the math. Marcus moved his $20,000 to an online high-yield savings account, paying 4.5%. His first-year interest is about $900 before tax. Compared with Linda's $90, Marcus earns $810 more before tax. After a 22% federal rate and 5% state rate, Marcus keeps about $657. Linda keeps about $66, so Marcus is ahead by roughly $591 in the first year. That is real money. That move matters. He corrected the obvious mistake, but there is a second trap hiding inside the improvement. Once Marcus sees $900 instead of $90, he feels like he has reached the destination. A better bank rate feels like victory because he compares it to a terrible bank rate, not to the cash market underneath it. If Treasury bills are also yielding around 4.5%, the headline income may look the same, but the after-tax income may not. High-yield savings interest is generally taxable at both the federal and state level. Treasury bill interest is federally taxable, but generally exempt from state and local income taxes. So using the same $20,000 at the same 4.5% gross yield, Marcus earns $900. In a regular high-yield savings account, with 22% federal tax and 5% state tax, he keeps about $657. In Treasury bills, if the state tax does not apply, he keeps about $702. That is only a $45 difference in 1 year at this tax level. Not life-changing, but structurally important, because the bank is not magic. It is another layer, and the layer has a business model. Linda gives the bank $20,000 and receives 0.45%. The bank does not put her exact bills in a little vault with her name on them. Banks use deposits as part of a balance sheet. They support lending, they hold reserves, they buy high-quality securities, they manage liquidity under regulation. The details are complicated. The spread is not. On the consumer side, a bank might collect around 7% on mortgages, 8% to 12% on auto loans, and 20% or more on credit cards. That does not mean Linda's exact $20,000 is secretly being loaned to someone at 21%. Credit card lending has default risk. Mortgages have duration risk. Banks have capital rules, operating costs, and regulation. But the economic point is simple. The customer sees one number, the interest line. The bank sees two numbers, what it pays for money and what it can earn with money. Linda focuses on the noun, savings. Marcus focuses on the adjective, high yield. The bank focuses on the spread. On Linda's $20,000, paying 0.45% costs the bank about $90 per year. If comparable short-term government yield is 4.5%, the gross yield available in the market is about $900. That $810 difference is the quiet spread before bank costs and profit. If low-cost deposits support a loan earning 7%, then $20,000 of funding supports about $1,400 of gross annual interest on the asset side, while Linda receives $90. That spread can be more than $1,300 before expenses and risk. Again, Linda did not lose principal. She lost the yield her cash could have been earning somewhere else. Over 3 simple interest years, Linda earns about $270 before tax at 0.45%. Marcus earns about $2,700 before tax at 4.5%. And if the bank can earn 4.5% on safe short-term assets while paying Linda 0.45%, the gross difference on her balance is about $2,430 over 3 years. That is a vacation, a set of tires, a medical deductible, 1 month of rent in many cities. Now taxes can make the same yield look very different. Assume the same $20,000, the same 4.5% gross yield, and a 22% federal tax bracket. In California, if someone also faces a 9.3% state tax rate, $900 of high-yield savings interest may be reduced by about 31.3%. They keep roughly $618. A Treasury bill at the same gross yield may only face the 22% federal tax, leaving about $702. Difference? About $84 a year. In New York, using a 6.5% state rate, high-yield savings may leave about $643. Treasury interest may still leave about $702. Difference? About $59 a year. In Texas, with no state income tax, both may leave about $702 after federal tax. So in Texas, the Treasury tax advantage may not be the reason to switch. The decision becomes access, fees, simplicity, and whether the bank quietly lowers the rate later. Over 5 years, ignoring rate changes and compounding for simplicity, a California saver with $20,000 at 4.5% might keep about $3,090 after tax in high-yield savings. Treasury interest might leave about $3,510. That is a $420 difference. In New York, the 5-year gap might be about $295. In Texas, the tax gap may be close to zero. Same yield, same balance, different after-tax outcome. But there is a danger in taking this math too far. Convenience has a price. Over-optimizing has a price too. There are 4 common places people park emergency cash. A big bank savings account gives maximum convenience and FDIC insurance, but often very low yield. A high-yield savings account gives FDIC insurance and better yield, but the rate can change and the bank remains a middleman. Treasury Direct gives direct Treasury ownership, but the auction schedule, settlement timing, and website can feel clunky. Treasury bill, ETFs, or Treasury money market funds can be easier inside a brokerage account, but they have expense ratios, market pricing, bid-ask spreads, and they are not FDIC insured. If a Treasury bill ETF yields 4.5% before expenses and has an expense ratio around 0.13%, the net yield may be closer to 4.37% before taxes. On $20,000, that is about $874 instead of $900. A $26 annual drag, still far better than Linda's $90. But the cost is real, and if someone keeps too little cash instantly available, then has to carry a $2,000 credit card balance at 24% APR for 1 month because a water heater breaks on a Friday, that 1 month costs about $40. One avoidable month of credit card interest can erase much of the annual Treasury tax advantage over a high-yield account. So the best cash strategy is not the one with the highest theoretical yield. It is the one that prevents expensive mistakes while reducing unnecessary spread. For a practical example, take Linda's same $20,000. Option 1, she leaves all of it at 0.45% and earns about $90 before tax. Option 2, Marcus leaves all of it at 4.5% and earns about $900 before tax. Option 3, a layered system keeps $3,000 in checking at nearly 0%, $5,000 in high-yield savings at 4.5%, and $12,000 in Treasury bills or Treasury-backed funds at 4.5%. The high-yield portion earns about $225. The Treasury portion earns about $540. Total gross interest, about $765 before tax. That is $135 less than putting every dollar at 4.5%. But it buys immediate access for bills, debit card timing, rent, groceries, and small emergencies. Compared with Linda's $90, it still recaptures about $675 of gross annual yield. That is the point. Not perfection, better design. If Linda spends $4,000 a month, she might keep $3,000 to $4,000 in checking, $4,000 in high-yield savings, and move $12,000 to $13,000 into Treasury-backed cash exposure after understanding how access works. Her old setup produced about $90 before tax on the full $20,000. A layered setup with $4,000 in checking at 0%, $4,000 in high-yield savings at 4.5%, and $12,000 in Treasury bills at 4.5% produces about $720 before tax. That is $720 per year before tax while still keeping $8,000 close. Over 5 years, without assuming rising rates or reinvestment gains, that difference is about $3,600 before tax. For Marcus, the move is more subtle. If he spends $5,000 a month, he might keep $5,000 in high-yield savings and put the remaining $15,000 in a Treasury bill ladder or Treasury-backed fund. His gross yield may not improve much, but in a high-tax state, he might save $50 to $100 per year on $20,000 while reducing dependence on a bank's promotional rate. Linda's problem is obvious underpayment. Marcus's problem is quiet complacency. The layered system works because it respects both fears. Linda fears she will not be able to get the money. Marcus fears he will miss out on yield, so each dollar gets a job. Checking is for timing. High-yield savings is for immediate shock absorption. Treasuries are for reducing the hidden spread on money that is emergency money, but not tonight's grocery money. The math reveals the trap, but the next question is more personal. If the smarter structure is available, why do millions of people still leave their cash where the bank benefits most? Linda is still looking at that interest line, $20,000, about $90 a year before tax, a number so small it almost feels like a typo. And Marcus is still looking at his online savings account, feeling much better. Same $20,000, about $900 a year before tax, 10 times better. And that is why the trap is so easy to miss. Linda chose safety and got underpaid in a way that was obvious once the number was visible. Marcus chose a better rate and felt like he had escaped the entire problem. But he had only escaped the worst version of it. What neither of them saw at first was that their emergency fund was not just sitting quietly in a digital vault. The bank was not simply guarding their money out of kindness. That cash was part of a larger machine. The bank thinks in spreads, what it pays for money, what it can earn with money. Linda saw a savings account. Marcus saw a high-yield savings account. Professor Wealth saw the missing question underneath both of them. Who is collecting the yield from your cash while it waits? Linda is not careless for wanting FDIC insurance, liquidity, and separation from her checking account. Those are good instincts. Marcus is not wrong for moving away from a big bank paying almost nothing. That move can put hundreds of dollars a year back in his pocket. But a bank label is not the final proof that cash is working efficiently. Linda's $90 felt safe. Marcus's $900 felt smart. And behind both numbers was the same quiet spread, just smaller for Linda and larger for Marcus. The practical answer is not to make emergency money complicated for the sake of a few extra dollars. It is to give each dollar a job. Near-term bill money belongs in checking. Roughly 1 month of core expenses can sit in a high-yield savings account for fast access and peace of mind. The rest of an emergency fund can be considered for Treasury bills, Treasury bill ETFs, or Treasury money market funds, but only after understanding timing, taxes, fees, access, and the difference between FDIC insurance and government-backed securities. If this video helped you see something you did not know was there, subscribe to Smart Money and hit the notification bell. We break down the hidden math behind the financial decisions you face every day. A savings account is not evil, but cash has a job. And if your bank is earning Treasury level returns while paying you less, your safety may be quietly overpriced.